Fernando. Good day, everyone. I see that we indeed cover quite some time zones. That's fascinating, and I hope I can inform you a little bit more about this study and our other work on basically on risks, capital, and finance. And the structure of my talk is rather simple. I will talk about risks, finance, and policies, introduce a little bit the concepts, how they interact, and how important they are, this interaction. Then I will dive into the work we did under this DiaCore project, this European project on focusing in, zooming in on onshore wind. And also part of that, what can be done to reduce the cost of capital, because this DiaCore study showed that there are quite some differences among member states, partly policy driven. So I start with a short introduction of what kind of risks are during the project lifecycle. Here you see a very rough sketch of the project cycle. Typically it starts with planning, where all the permits, etc. need to be collected, but also the viability of the project needs to be explored, finance needs to be arranged, etc., etc. Then the construction phase, where actually the money is being spent, and in case of renewables, that's where most of the money flows to, because of the high capital expenditures and the relatively low operational costs. And then there's the operation phase, typically for 15, 20 years, and that's ended with the decommissioning phase. And each of these phases has its particular risks, and they occur during, well, either one or more of these phases. Typically, there are the kind of baseline rate or the country risks. Each country has a particular risk. For instance, when it comes to legal issues, contracting, the economic situation, that's all reflected in a country risk. And it's clear that in some countries, well, just to put it really blunt, I would not invest in wind energy in Syria today because of the many country risks. But clearly there are many more subtle changes between countries. There are social risks that typically deals with public acceptance, and that differs also per country, and we will see that a little bit later. The administrative risks, how to get a permit, how sure am I that I will be able to build a project. And if we zoom in later on wind onshore in Europe, and if you then remember that this planning phase can take 2 months to 154 months, so it's widespread, then clearly if you have to wait for 154 months, then you need to be, well, sure to have the patience but also the security that you will see your project continuing. Financing risks, all phases, has to do with the conditions for financing, but also market conditions. Then there are clearly technical and management risks. Some things might go wrong during construction. During the operation phase, you might occur certain problems. All these have to be important, are important. Grid access, without grid access in case of a wind turbine, you will not earn any money, so that's a key aspect here. And then during the operation phase, the policy design risks, where in Europe most countries use some kind of support scheme to support renewables. Clearly, the design of these policies and the size of the support are important for project developers and project financiers. Market and regulatory risks, similar category. And then we have the sudden policy change risks, what we have seen in Europe as well, where sudden new governments change the rules and can really jeopardize a certain plan, a project plan. So they all interact, and it's basically the higher the risk, the higher the finance costs, because people are not willing to lend under all conditions the money that you need for the project, or people are not willing to invest as much money in a project because of the high risks. If finance costs are high, then policies need to compensate for that, and well, they influence these risks. If they do it right, then they reduce risk. If they don't do it right, they might even increase risk, and so it could be a positive cycle or a negative cycle. And clearly, The idea is that policies should help to reduce risk, reduce cost of finance, reduce the need for government support, and that would be a situation that we would be striving for in the near future. Costs, finance costs, or the cost of capital can be significant. This is just an example, a quick calculation for a wind project, and I think a lot, especially policymakers, underestimate the significance of the cost of capital. So here you see on the left side the technology cost, that's capital costs and operational expenses. Then in this example, the project developer the investor needs to pay taxes. And then you see two boxes on top of each other of the finance cost. And one is the cost where and the total adds up, let's say, to 70, 80 euros per megawatt hour, which would be a fairly good wind situation in Europe. And these two blocks under finance costs show you the difference of when this investor applies a 15% or a 7.5% discount rate. So 15% if he perceives that the risks are too high, that there may be policy risk or market risk or administrative risk that make him to be very conservative or rather conservative, whereas with 7.5% it's much lower. And with 7.5%, the finance costs would be something like 11%. That's 11% in this example, and if you double the discount rate, then basically these finance costs also double. And they are important. So about roughly a quarter of the levelized cost in this example is finance costs. So where do these risks have the most impact on? This is what you would typically, the key financial parameters that are relevant to a project developer. So you have development expenditures, you have capital expenditures, operational expenditures, and let's say in 20 years you have decommissioning cost. Another element is time. How long does it take to develop? How long does it take to construct, etc. Then there are what we are mostly aware of, the debt and equity parameters, the money that you lend from the bank or the money that you put into it. And then it's really the structure, the ratio of the two, the conditions, particular conditions, they determine in the end whether or not you will be able to get the financial closure. Clearly, it's also the interest rates or the discount rates being applied, the terms, etc. Then taxes, they also we have seen that in the example before, make an important element. And the key of everything, the income, so the power purchase agreement or the income from renewable support schemes, they are critically for the project. They should compensate for the expenditures at the beginning. So the first row, development, etc., time and income, those are really important parameters for project development. Here you see an example of an offshore wind project. So it's a huge project, 500 megawatts. And just to give you an indication, that's something like 1.4 billion euro of investment. And here we assumed 5-year development, 2.5-year construction, and then 25-year of operation, and then in 1 year a decommissioning. Here you see different elements of the cash flow. So at the beginning you see there are some relatively small expenditures for development, then the investment phase, and then typically the operation phase where you have income and where that should balance for it. This black line is the so-called free cash flow, and the shape of this free cash flow determines the overall net present value and the internal rate of the return of this project. So basically the discounted surface under the positive so the positive lines should compensate for the investments at the beginning, and that ratio is being determined by the discount rate. Here you see this net cash flow, but also this the lower line, the discounted free cash flow, where we assumed here that the investor uses a 15% discount rate. So the surface in the future, let me just check because I can have a pointer. Yep. So, sorry, this surface under the dotted line, that should be bigger than the surface above the expenditures at the beginning to make the whole project viable. And it also shows that especially costs incurred at the beginning and risks at the beginning can have a big impact. So the size of the development phase, the amount of money that you need to develop your project is very important. Period that it takes to develop. If you need to wait a long time for a permit but still have to pay salaries of the lawyers, etc., that will add up and that could have a risk. Clearly, the period, the construction period, if you can do it really fast, and then you can start operating again, and the size of these investments, and then the level of the income during the operational phase, that also has impact. But it's also clear that at a high discount rate, as shown here, really about after 25 years or 30 years, the impact for today's investment decision is rather small. So risks early in the project life cycle have a higher impact on the present value of the project. And this is something that might sound rather counterintuitive, but for instance, if you look at the development costs at the beginning, they make, let's say, 2% of the total levelized cost of electricity. So you would expect if we reduce the development cost with 10%, then, well, maybe also this levelized, this 2% will be reduced to, let's say, 0.2%. But due to the time preference of money for an investor, basically the levelized cost is it's not 0.2%, but it's almost 1%. So it has a relatively big impact on the investment decision. So what was the DiaCore project about, and what lessons can we learn related to my previous part to the cost of capital? Now, DiaCore is a project, and Fernando already introduced it, that a consortium of different European consultancies and research institutes with project coordinator Fraunhofer EASME in Germany, with support from Ecofis, Eclairion, the Technical University of Vienna, the National Technical University of Athens, and the LAE, together, and some other partners, we executed. And in this particular task, Ecofis had the lead, but we had a kind support of our colleagues at Fraunhofer and Eclairion, and the others, Vienna and the Technical University of Athens. We looked at this cost of capital. And the key questions and the main objectives were, well, look at the role of risk, try to quantify it, and how this influences the investments in renewable energy sector, and compare the cost of capital and show why this matters. So I already showed you that that it is important, but the comparison is something different, and to provide solutions in order to enhance investments in the renewable energy sector. And we looked at wind onshore because there are most data available. Basically, the statistics work best. It was easier to find good data. Then to explore what is the range between the cost of capital in these 28 EU member states, and why is there such a range? Because it's quite significant. And what are the risks that have the most impact on these investments, and how can policy design changes affect these cost of capital? This subtask report was launched yesterday. It was published yesterday. It's available on the DiaCore.eu website. And here I will present the main results. We started, this is the rough methodology. We started by building a theoretical model which basically tried to determine what are the cost of capital from a, let's say, academic approach. So we used the capital asset pricing model to determine the risk premiums and the beta figures, if you are aware with that, to calculate cost of equity and cost of debt for all member countries for onshore wind. for that we did quite a comprehensive literature study, and we used the renewable energy barriers database that Eclairion has, which has more than 900 listed barriers. They made already an inventory of risks per member country, and so we could use that to get a better idea of where the biggest risks occurred. Then we drafted these country profiles. So what are in our, let's say, from a theoretical perspective, should be the discount rates and the debt interest rates. But we know that these models may have flaws or may not be accurate. So we did interviews and we used these, let's say, theoretical outcome and asked the financial experts to reflect on these assumptions. So we did interviews in almost all member states, and we asked them also to explain why they thought that some of our outcome was too low or too high or whatever. What are the underlying assumptions of the model? And the estimated partners, do you agree with our assumptions? Would you pay more weight on, etc., etc. And based on that, we basically corrected the model results. But to be honest, we already made quite a good estimate. Let's say there were some corrections clearly, but the model already provided a quite sound set of data that we could use. It's all reported in the document. Then we aggregated all the EU-wide data, and we presented the results back to some national experts. And clearly we produced a report and are now active in spreading the word and disseminating the results. So what about risks? One of the elements was that we asked what are the main risk categories that you think are most important for your country. So for 24 member states, we had an average ranking of these risks. And policy design risks were perceived as the most pressing risk to onshore wind energy projects across the EU. And we can derive from this very high ranking that the design of this support scheme is still one, if not the key prerequisite for stable investment conditions. And several experts referred to the policy design as being the rules of the game. And for this reason, the changes made in this policy design will have a huge impact on investors, as it will change the rules of this game and therefore bring uncertainty to investors. A next group of risk concerns these administrative issues, market design and grid access. And they are slightly lower, but more or less at the same level. And the people that we interviewed revealed that in most countries there are issues with obtaining grid access for renewable energy. So it is highly uncertain if you develop a project that there will be a grid access after all. And with increasing shares of variable renewable energy sources and a lack of clarity on responsibilities for grid connection or enforcing and bearing the costs, it can be expected that this will become a bigger issue in the coming decades. And then at the right side, the last group, you will see risks related to social acceptance and sudden policy change and financing risks. They are in some countries, and we will see that later, perceived to be very important, whereas in others they are not relevant at all. So this is an average, EU average you could say, but there are clearly some differences per country. Technical and management risk is, let's say, lowest as perceived risk. Clearly, especially for wind energy, there is a resource risk. What if the wind resource is not as high as expected or deviates from predictions? But clearly there is a lot of development has been going on. It's let's say the estimates of wind resources, the measuring, etc. The prediction is advanced in the last decades. So that's not the key issue. And also suppliers are willing to take, for instance, some risk because the technology is mature. Here you see how, let's say, the number one policy risk differs per member state. So there are some, we have here these categories: policy design risk, administrative risk, market design and regulatory risk, grid access risk. and some rest countries. And what you see is that policy design is ranked as the most important risk in 10 out of the 28 member states, followed by administrative risks. If you count the countries, then it will sum up to 7, and market design and regulatory risk in 3 member states. So this chart shows a broad distribution of these top 3 risk categories across member states, but they are present in all parts of the EU. We will look a little bit closer to that, and this is a spider diagram showing how the risk perception differs per group of countries. So we first have these risk categories, which are the corners of the spider web. So from top, administrative risk and grid access, market design, policy design, financing, etc. And then the different lines reflect the countries, which are also depicted on the right bottom. So the Northwest European countries, the Eastern European countries, and the Southern European countries. And what this graph shows is that there is not a really there are no differences across regions in the perception of grid access risks. They are more or less the same, and relatively small differences for policy design risks across the geography of Europe. And for every region, the policy design risks are perceived as most important. So they are big, but in all regions basically, with East and South regions scoring slightly higher than the Northwest region. The graph also shows differences between the regions, the biggest difference being the finance risk category. Financing is not such a big issue in Northwest Europe, but for the southern countries this is perceived as the most pressing risk after policy design. The financial crisis in the last years has had a severe effect, in particular on southern European countries. Clearly we know that. And this crisis reduced access to loans and makes wind energy investments more risky in regions that have been hit hard by this financial crisis. So this risk increases the cost of financing and thus the levelized cost and thus the support for renewable energy, because wind energy has high capital expenditures. And we all know that the capex make the biggest chunk of the levelized costs in onshore wind. And in order to outbalance the increased levelized cost, higher reimbursement for the produced electricity is needed, and that puts additional burdens on member states going through a financial crisis. They need to reserve more money for policy support, and this could be a cycle that is really going into a negative spiral. Another conclusion that you can draw from this chart, which again was based on the interviews with different stakeholders, is that the different perception of social acceptance risks. This is ranked highest in the Northwestern countries. And the market design and regulatory risk also seem to be more important in these northern countries. And this could indicate that current market design and regulations are no longer fulfilling the needs of the RES developers, particularly in that region. And then finally, sudden policy change. So that's on the left side of the spider web. That was reported as the most pressing risk in Eastern European countries. And in accordance with that observation, interviewees from this region mentioned that over the years renewable energy has lacked political will, resulting in several policy design changes and a loss of money during project development phases. So there are differences, and we are going to see how this is being reflected in the cost of capital, in the, let's say, the elements that make the cost of capital. Well, the first one is the cost of equity. So that's basically the hurdle rate that an investor will use when he assesses, makes his own cash flow, and when he wants to decide whether or not to invest in this case in onshore wind. And what this figure shows is that the range is quite big, even within the European Union, going from 6% in Germany to 20% in the Baltic states, 15 to 20%, something like that. So the risk premium in those countries, for various reasons, that could be both renewable energy policy design or general market or country risks, makes it, for instance, in this case in the Baltics, apparently that the costs are the risk premium is high, and hence the cost of equity is relatively high. Next to Germany, you can see that, well, there are some countries that also are, let's say, below 10. It's then, or in that range, it's let's say Sweden, Denmark, the UK, Ireland is a little bit higher. And there are some countries that are closer to 50%, like Spain, Greece, and Malta. Looking at the cost of debt, so the money that you need, that you lend from a bank, that ranges, again in Germany as a lower threshold, from about 2% to Greece and basically only Greece to 12.5%. So that is a huge difference, which clearly is related to the economic situation in that country. But also, it's not only the overall economic situation, it's also the level of competition. What interviewees in Germany report is that banks really compete for wind projects. So they really do everything to offer the most competitive price to project developers. And because it's a big market, that pays off in lower debt rates. Another element, and I skipped it before, which is important, is the share of debt and equity. How much money can you lend from the bank? And banks typically use as a parameter to evaluate that, the debt service coverage ratio. How much money will the project be able to deliver with some ranges, and that should be the starting point for paying back debt and interest, pay back the loan and pay interest. And based on such an assessment, the bank is willing to lend money. If the risk is high, then the investor has to pay more. And here you see, for instance, in Greece, it's 55% the bank is willing to lend, but 45% has to come from the investor. Whereas if you have if the risks are low, and basically the income of the project is more or less secured, then they are willing to lend much more, and 80%, for instance, in Germany, and against 20% equity. And because the cost of debt is typically lower, in the case of Germany, it's 2% compared to 6% for equity. The more money you can lend from the bank, the lower the overall cost of capital. And these differences, I think, are quite striking, and especially because in these countries that already have a relatively high share of equity, they also typically have high risk premiums for this equity, which adds up to higher costs of capital in total, which I'm going to show to you right now. So this is the weighted average cost of capital. So a combination of both debt and equity. The formula is given there for those of you that are not aware of it. There's a correction for text here. And here you see that these overall cost of capital ranges from, let's say, 3.5% in Germany to something like 12% in Croatia and in Greece. So almost a factor of 4 across Europe. Other countries with relatively high average cost of capital are Spain. That has typically to do with the policy changes in the last couple of years, which are really not favorable for wind energy. Poland also relatively high, and let's say countries that come close to Germany are Belgium and France, and to some extent also the Netherlands. A lot has to do with, as explained, the economic situation of these countries, but clearly a lot also has to do with the policy design, because there are some changes there as well. Here you see the relation with let's say the risks, the WACC categories highlighted in the colors shown here across the different support schemes. So from top to bottom, it's feed-in tariffs, like in Germany, a premium tariff, like for instance in the Netherlands or in Germany, or now also in the UK, contract for difference type of things, quota schemes with certificates, tender schemes, or other schemes, often combinations. And at the first glance, this figure does not show an obvious link between the choice of a particular support scheme and either a high or a low WACC value. Markets with a quota scheme, such as Belgium, can still reach a relatively low value for this weighted average cost of capital. And in some markets offering a feed-in tariff, the capital cost can still be very high, whereas a feed-in tariff is, if it's secured, it's really a nice income for a project developer. So there are other things at stake here, and it's important to take two factors into account. The first is that the specific design of the support scheme. For example, Belgium offers a very favorable minimum price for these green certificates, so the bottom price is already quite attractive and takes away a lot of risks for any investors. And then the other element is the country-specific risk, as I also told you about a little bit before. Many markets still struggle with the aftermath of the financial crisis, and in such a situation, the country risk seems more decisive than the policy design risks or the design of the national support scheme. And as a consequence, comparisons between support schemes are only meaningful if the overall country risk is similar. So it's good, for instance, to compare more or less homogeneous markets as Denmark, Sweden, and Finland. All these countries have a very low country risk, but the overall WACC in Sweden is significantly higher than in Denmark and in Finland. And according to the Swedish investors, the higher investment risk is actually mainly due to the shortcomings of the support scheme, which does not offset existing price risks. So it's here really a policy instrument design that is making the difference. Well, apart from such an obvious example, other assessments are more difficult to make. So national values for the WACC depend to a large extent on the specific design of the support scheme. And the main conclusion here is that the devil is really in the details. And later I will address a little bit more on that when I touch upon AAA policies or policies that could help to lower the risk. The conclusions of the DiaCore project are that, well, summarizing this, so the cost of capital range significantly from 3.5% in Germany to 12% in Greece. And that's because of the big ranges in the cost of equity and in the cost of debt and in the range of debt equity that's summarized here. High cost of capital lead to increasing wind onshore deployment cost, and across all member states, the risk induced by policy design is perceived as most pressing by the interviewees. Now I take a sip from water, one moment. So what can you do to reduce the cost of capital? And I will not address all elements given here, it's in the report, but I would just highlight some for the sake of time. Clearly, during risks differ across the phase of a project cycle during planning, construction, operation. Different policies could reduce risks that are occurring in those phases. Looking at country risk, well, there you see, let's say, a list of the type of risks that are considered as a country risk: political stability, societal stability, how the government is arranged, corruption, legal system, etc. But here I want to focus on the economic situation and development. In general, all these sub-risks, so to say, apply to any investment in a country, not only for renewable energy, and they clearly differ per member state. Looking at the economic situation and development, which is also often categorized under a country risk, there I think that may not be that relevant for the short term, but that's more a longer term vision that The role of renewable energy in the value creation of an economy and the long-term economic development can be very important. And so indirectly, renewable energy could be used to reduce the country risk by building a strong economy based on renewable energy. If your country has, let's say, the resources available, both in well, technology, knowledge, etc., then it can really contribute to, on the longer term, to a more stable economic environment, which will in the end drive down the cost of capital. So here you will see some examples. So you can promote strategic investments just to make sure that you attract your money to the right levels of support. You know, an example that I give is often the situation of the onshore wind industry in the Netherlands and in Denmark. 2 decades ago, the Dutch were quite prominent in wind turbine technology, 3 decades ago. But basically, due to wrong policy, industrial policy, that stopped, and it was picked up in Denmark, and that's now one of the biggest exporters of wind turbine technology. At the same time now, the Dutch government has recognized that offshore wind energy offers interesting perspectives for the Dutch economy, not because of manufacturing wind turbines, but because of the offshore service sector that is big and that is a global player, and that could play a significant role, and in fact plays a huge role in constructing offshore wind projects in Europe. So there you try to really enforce the elements in your economy that you're good in. There are some other elements given here that I will not address, but it's about the combination of policy, industrial policy and renewable energy policy. On social acceptance risks, well, they're basically delay or the cancellation of projects, that is the risk. And then we have the not in my backyard issues, or, sorry, not on planet Earth. In an even worse case, this really is a huge risk in many cases, and that explains why permitting can take 2 months in some regions to 150 months in others. So it leads to high development costs, longer development periods, which you want to avoid. So in good policy ingredients are really have all to do about stakeholder participation. Even new innovative democratic models could help. We have had as Ecofis experience with a process of participative co-creation here in the city of Utrecht, where basically the council asked 200 randomly selected citizens to make an energy plan for the city. They fully delegated the responsibility of that to the citizens, but they were supported with civil servants, by experts, by us as Ecofis for process and content, and they come up with a plan that hopefully will be a very sound basis for new renewable energy projects. So it's really about making sure that people are aligned and that you smooth the development phase. Administrative risks. Well, the procedures, if they are long, then they will that is inherently more risky. So if countries arrange spatial planning, environmental impact assessment, etc., health and safety issues, if that's taken care of in a responsible and clear way, then project developers can anticipate and deliver the best wind project as possible. So streamlining is important, education of civil servants, guidelines, best practices, one-stop shops, they all can help to ease the administrative process and reduce the risks. Then financing risks. So their time is an important risk. During the project development phase, all kind of financial economic parameters can change. The markets, interest rates, exchange rates, if you need to import from another currency, they all might change, and that's can jeopardize the financial closure of your project. So how to ensure that projects are bankable and investable after the development phase or at the moment of refinancing, that's one of the key financing risks, and how to secure income during the operational phase. Well, there you see different type of policy ingredients that can help. Governments or public-private investment funds and banks can help to either act as a catalyst or as a safety net for other investors or lenders. So in Europe, we have the European Investment Bank. If they are involved, if they have assessed the project and think it's worthwhile, then they clearly bring with them, or others will follow that example, simply because they can share the risk and because of the expertise that is in this bank. Loan guarantees, export credit facilities, they all can help to reduce risk. Another important thing is that the policy support scheme really needs to look at how the financial market looks at these projects. So if you can align it with their practices, that's really important. So front loading, where you give a little bit more subsidy at the beginning of the project phase, that is more attractive to investors than, let's say, a fixed rate over a longer period. If you can bank, have more flexibility in your income, that's also helpful. So some support schemes limit the support to a certain number of full load hours of wind production, and if there's not enough wind, you basically lose this subsidy. But in some cases, if you cannot consume all the policy support in 1 year, you can bring it to the next year and you can bank it. So if in the next year there's more wind, you can still benefit from this support scheme. Technical and management risks, and I will go through that a little bit faster. This is typically the domain of the project developer. Governments can help here by providing performance and risk databases, or making sure that the industry develops this, which should be rather open to any investor, to get better insight in the particular risks and in the solutions that people have found to mitigate those risks. They can also help with providing some guarantees and insurance. You have seen that for geothermal energy projects where there is quite some risk in not drilling in a good reservoir. Then a government guarantee can help, or insurance. I will go a little bit faster now. So grid access risks, well, they are crucial. If you have no grid, no project return, and that will mean that the project will go default. So clearly during the development phase, the process, the procedures and the timing needs to be clear, and the different roles of all actors needs to be clear and well defined. At the start of the operation phase, there is a risk that, especially for offshore wind, for instance, that the grid is not ready yet, and there you really have to negotiate and have a good interface and security that you have arrangements for any loss of income to the project developer. And during operation, especially if renewables start to increase, if there are more and more, then, for instance, it has to be clear whether the project is open for risk of curtailment, etc. So clear processes, procedures between all actors, governments, regulators, grid operators, that's really a key ingredient of a good policy. Then on the policy design risks, we also looked at these differences between the different, let's say, flavors that are quite common in Europe, which are either a feed-in tariff, where you get a fixed price for a certain period for your electricity, a premium, where you get either a fixed or a variable premium on top of the electricity market price, or a quota scheme where both electricity market price and the value of the certificate can vary. Well, from a theoretical perspective, they all have a different risk profile, and we have had some interviews and they support this, but it is not really straightforward. It also depends, like on many other things, on details. For instance, the size of the feed-in tariff. In the Netherlands, where we are based, as in Germany and in the UK and in Belgium, but in the Netherlands we had in the past a feed-in premium, but it was so high that the risk was really minimum, because basically there were a lot of windfall profits to be made by investing in renewable energy. That has changed now. So reduce the revenue risk is a policy ingredient that governments could apply by using contracts for difference instead of fixed premium systems. Think of flexibility, banking, reduce compliance risk by careful tender design. If you have a tender scheme for instance, to get access to a feed-in tariff, for instance, and really work on increased predictability of policy influences on the market developments, so that people upfront are aware of the direction of changes, scheduled changes. I will address this really short. So market risks are important. There it is good if a policy instrument design really incorporates some provisions for revenue risk, so especially if electricity prices are negative or extremely low. And if curtailment has to occur, then it's clearly also important that it's clear upfront, or that there some provisions are taken to compensate for that. Well, sudden policy change risks. So any unexpected, unanticipated, short-term announcements or sudden changes of policies or policy design features. Here, the key policy recommendation is don't do it. Because that is a killer. I even think not only for the renewable energy investment, but it really destroys the confidence of any market actor in markets that still need some type of policy support. So yes, you can correct it if you have over-subsidized it. Clearly, you should and you can correct it, but retroactive actions, as seen in some countries in Europe, are really disastrous. So concluding, so here's some key features of AAA policies for renewable energy, and including wind onshore. They should be tailor-made, addressing these key financial challenges of a particular project, market combination, and country. And I gave some examples before. They need to be aligned to one another and embedded in a broader economic policy context. So don't develop only renewable energy for kilowatt hours, but do it to really strengthen your economy and think broader, think wider, integrate it, so that it becomes part of your economic system. And if all countries would have the same renewable energy policy risk profile as the best in class, and that is for wind, that's Germany, then we made a very indicative assessment. Our partner with the GreenX model from the TU Vienna did. We looked and we could save about 15% of policy support costs for wind onshore until 2013. So then we accept that there are differences in country risks, but if we really remove all the policy premiums, we think you could save about 15% of your policy support cost. So in general, renewable energy policies should result in a dynamic, responsive lock-in into renewable energy, which is to some extent rather incoherent, or maybe even, well, not logical, but yes, it should be dynamic. It should be able to respond to changes in technology, in markets. It should be responsive, looking to that. But it should also provide a kind of lock-in, so that it's really not attractive to move away from the path that we need to go. And since the COP in Paris, it's really clear that the world needs a lot of renewable energy to stay below the 2 degrees, let alone the 1.5 degrees Celsius climate change. So we need to create some kind of lock-in because a lock-in reduces a lot of risks. It provides investor certainty, and that will drive cost reductions through innovations, learning, economies of scale, and through lower cost of capital, the key topic of my talk until now. So with that, I would like to thank you for your attention, and I hope that Fernando can guide me through the Q&As.